The taxman will never know. You never get any growth on it.
Well, you are a tax evader. We've already established that this episode. Hi, and welcome back to another Meaningful Money Q&A with me, Pete Matthew.
And allegedly me, Roger Weeks.
The man, the myth, the legend. How you doing, bud?
Yeah, I'm a leg end. Yeah, yeah, I'm doing really well, thank you.
Big week in the Matthew household this week. Producer Kate has had an offer accepted on her first house. I'm sure it'll feature in a Bank of Dad episode very soon.
I imagine it will do.
Yeah. So congratulations, producer Kate, and also youngest daughter Kate.
Yeah, and make sure you put some life insurance in place and critical illness and all that kind of stuff. You have to protect yourself.
She's well taught.
Yeah, I'm sure.
We were talking about it walking the dogs this morning, weren't we? What life insurance should I think about? Okay, where do people go if they want their questions answered? Roger?
If they want their questions answered, please send any emails to hello@meaningfulmoney.tv with the subject line podcast question, and Nick will sort them into a future episode for us.
Yeah, indeed he will. And we are answering questions from January 2026 currently. So if they're urgent, mark them as so, and we'll do our best to get them in a more timely manner. But as we're going through this today, remember any notes and links are at the show notes, meaningfulmoney.tv/QA52. So check that out there. And as always, if you're watching us on YouTube, channel's going very nicely, actually. It's growing nice and steady. Then help us out by liking the video. If you think it's any good, the jury's out. It's too early to decide that. But if you do, hit the like button, subscribe to the channel, and it really helps us out, so thank you for that. Let's dig into it. This is question 1. This is from David. Dear Pete and Roger, could you provide an opinion on if and when it would be worth at least considering leaving the NHS pension scheme due to tax reasons? Nice controversial start. Yep. I can sense immediate puckering. Great choice of words. And this is not something I ask on a whim. I am aware of the comparative value of public sector DB pensions versus other retirement savings methods, and indeed encourage the staff I work with to pay in. I am a senior doctor in my 40s with high NHS earnings and rental income on top. I am one of those affected by annual allowance tapering and have significant annual allowance tax bills every year with no end in sight. My projections are that I will have an annual AA tax charge of around £30,000 every year going forwards, as my income is pretty stable. The annual AA tax charge is up to 40% of the annual capital benefits accrued in any year. Lifetime allowance calc, 20 times pension, 3 times lump sum. Yeah, we understand that. I pay this via the Scheme Pays system, but Scheme Pays loan docked from benefits at retirement, is inflated at CPI plus 1.7 against pension benefits growth of CPI plus 1.5. So slightly worse by doing the Scheme Pays thing, but then at least you haven't got to find 30 grand, I suppose, per year. I don't expect much sympathy as a high earner, but no one wants to pay more tax than they have to, of course. And I never hear my situation talked about other than snippets in the depths of Reddit forums. My plan is to keep ploughing on and engage a full-scale planning review when I turn 50, leaving up to 10 years to consider avertive action once my wife and I have enough pension, enough in inverted commas there. Many thanks for your thoughts, David. No, we all have problems, man. It's that, you're obviously doing incredible work, highly paid in the NHS. For that, we should be very grateful, and you should be remunerated. But yes, with that comes problems, and that's what we need to talk about. Yeah. You have provided some context, with some specific numbers, which you've asked us not to read out, which is absolutely fine. But you can, just the fact that he is having a tapered annual allowance gives you some ideas to what the earnings are. Yeah. I mean, your first thought was what?
Don't do it. It's the first knee jerk, obviously, because it is such a good scheme.
Yeah.
And yes, you are paying the annual allowance charge, but you're deferring that by having the Scheme Pays on it anyway. So it's not affecting your standard of living at the minute. No. It'll affect your standard of living in the future. But my immediate thought was, yes, I understand it's painful. Don't get me wrong.
Yeah.
But you're losing 40%, so you're still gaining 60%. And I think what you've taken the approach right was that you'll keep ploughing on for the next between 5 and 10 years. You said you're in your 40s and you can do it at 50, and then take a straw poll then and say, okay, what do we need? Is that enough? Do I need to carry on? But it is really difficult.
It is. I mean, like every fibre of our being says, don't opt out, even though it's costly. The benefits will outweigh that cost, because that's what we see. every year you're buying benefits that will hopefully pay out for many years, and you're only paying tax on that extra benefits that you've bought once, essentially, right? But I do get the pain. It's too simplistic to just say, well, just stay in the scheme, right? So if we kind of thought experiment what you could do if you opted out, obviously you would stop accruing benefits in the scheme, but I imagine you've already got a pretty good baseline income level going to be paid out to you from pension age. So you could, your annual allowance would still be tapered. You do mention in your notes, though, that some level of contribution or employer contributions into the NHS scheme is included in GP's net profit figures. I didn't know that.
No, nor did I.
So I don't know what that affects annual allowance tapering. I'm not sure it would if it's employer. And it's DB, isn't it?
Yeah, it is.
So, yeah, okay. So like say, you could, if you opted out and you sort of recalculate what your adjusted income is, and then you could contribute to a DC pension up to your tapered maximum annual allowance, whatever that is. But then you could consider other tax-efficient options, I suppose. You could do that if you're in the scheme, though. If with spare money, couldn't you? You could VCT, build up in VCTs every year. Getting 30% tax relief on that, it would sort of offset the unpleasant tax bill every year, potentially. Something to think about. Just tread carefully, though. VCTs are high risk.
And psychologically, saying I'm no longer paying that £30,000 a year is quite nice.
Yes.
And I'm going to throw the money into my own pot, so therefore that should be fine. Your existing NHS DB pension scheme will still escalate, so whatever you've accrued already will grow up to your retirement age. But it's like Pete said, it's too simplistic to say stay in, because there are other factors in the background. But it just seems to me at this age, in your 40s, yes, taking the action you're saying, go to 50 and then say, have we accrued enough? And then would we not be too painful to come out from that point onwards?
Is it worth, assuming he's got the means, is it worth just paying the tax as you go rather than doing scheme pays and paying essentially...
but I suppose...
It's doing its benefits reduction, isn't it?
Yeah, so you get a reduction in benefits in the future based upon the loan you've taken out to cover the fees. But it's... I
want to do the maths on that, actually.
No, no. It depends, because like you said, Pete, is that you've got a really, really good accruing DB scheme already in place. And if you keep funding that till 50, you probably could afford to take a bit of a cut in income at that point in time and then save the cash that you would have, like Pete said, you could pay it in cash instead. Well, if you've got sufficient cash, you could throw that into ISAs or whatever in the meantime and build up an external pot around the side. Oh, my goodness.
As a balance to sort of paying the tax, you could continue with the scheme pays things, and instead, if you happen to have 30 grand a year that's burning all in your pocket, then you could, VCT that. I think that VCTs are made for people like David, because you get the tax benefits. They are somewhat accessible. You've got 5-year sort of access period, though. You would lose the tax benefits if you access them within 5 years. And because they're early stage investments or smaller investments as a rule, they can be less liquid. But there are some great VCTs around there which are reasonably liquid, and you can roll them over and get the tax relief on existing money every 5 years. So there's something to think about, but you need to understand what you're getting into.
Yeah.
But they're made for high earners, people with high tolerance for complexity and risk.
Yes.
So it could be something to consider.
But don't necessarily let the tax tail wag the dog. Don't do things that don't feel right for you. So,
well, it's impossible for us to say, just opt out. Feels fine.
Yeah, or don't you dare opt out. That again doesn't sound fine.
Puckering is right.
Yeah,
definitely a weird one. All right, hope that's helpful, David. Question 2.
Question 2. This is from Alfred. It says, "Dear Pete and Roger, I want to say a big thank you for all the guidance you provide. There really is nothing else like it, and it's been hugely beneficial in organising my finances."
Thank you, Alfred.
Well done, Alfred. And we didn't even write that for you, which is lovely. My question for you is how to structure gifts to someone who is going through the early stages of a divorce. My sibling is sadly in this situation, and our mother is looking to make a sizable gift to us following the death of our father. How should we be thinking about this, and are there any vehicles or structures such as trust that we could be using to avoid my sibling's spouse from being entitled to half of the gift? Grateful for any guidance you can provide in this matter. Best regards, Alfred. It is a horrible situation to be in, and we feel for your spouse, your sibling, Alfred. This is more of a legal question, really, but
definitely, it definitely is.
But if possible, we would probably be urging Mum not to make the gift now. At this point, defer it until. But the thing is, divorces take a long time, and
Yeah, I mean, I guess at some point, I'm not very familiar with this. I'm pleased to say, but I guess at some point the financial settlement is locked in. But
yes.
is it sort of potentially be reopened all the way till absolute?
Until absolute, I would have thought.
I mean, some people even go back after, don't they?
Yeah, because if you knew you're going to be receiving, don't let the siblings' partner at this point in time know about this. Because they could come back potentially because you've deferred it.
You've got to say to Mum, don't do it yet. Obviously, by deferring the gift, the 7-year clock starts ticking later and all that sort of stuff. But I mean, surely that's better than half of it going to a divorcing spouse, right?
Yeah.
I mean, from the way the question is worded, Alfred, it suggests that this is an outright gift. It's not a deed of variation on your late father's estate. If it was, then there might be time constraints. So that's got to be done within 2 years of the date of death. So, that might be a factor. But if it isn't, if it's just an outright gift, you've just got to say, just hold your fire, Mum. Don't do it. It's just going to overcomplicate things. Now, if she really wants to do it, you ask about structures, vehicles or structures. Well, a gift into a discretionary trust would serve a purpose. So Mum could put the money into a trust where son doesn't have absolute right. Is it son?
It says sibling, so I'm
sibling. So not necessarily. So it could be daughter actually. So a sibling doesn't necessarily doesn't have any right to that money, only a potential right. Because with discretionary trust, the beneficiaries are usually declared as classes. So, Mum would be the settler setting up the trust, and she could say, the beneficiaries of this trust are my children, right? Not named, my children. And it's up to her as both settler and trustee to decide which child benefits and to what degree. And that sort of lack of absolute interest would keep it out of the, grasp.
Divorce.
Yes, out of the grasp of the divorce. But setting up a trust is not to be done lightly. There are loads of costs and hassle and admin issues. It's got to be registered with the TRS. You'd have to do an annual tax return. Depending on the size of the gift, there may be initial inheritance taxes to pay. There may be ongoing taxes to pay. Inheritance tax to pay. There would certainly be income taxes to pay at the highest rate. You don't set up a trust lightly. Is something you definitely need to seek legal advice on this case. But I bet you the divorce lawyer would be saying, for God's sake, don't make that gift.
No. Hold on as long as you can.
Yeah. All right. This is from Steve. Hi. You're welcome, Steve. I'm glad it's been helpful. I've held several GIA accounts for many years, and I hold accumulating ETFs within the GIAs. Oh, yeah, I remember now.
Yep.
Occasionally, I have had to pay CGT through my self-assessment when I have sold these ETFs. Mostly, I have always been a basic rate taxpayer. I have recently discovered that HMRC requires excess reportable income, ERI, to be declared on accumulating ETFs. In the case of ETFs which receive company dividends, this means I need to take note of the reporting date of each ETF and add up all the notional dividends as if they were paid on the distribution date 6 months later. And if it's over 500 quid, I should have paid dividend tax on the excess. Also, in the case of some of the money market fund ETFs I hold, these may have an ERI notional interest payment, and this would count as being potentially subject to income tax. Since I have sold many of these ETFs and I have not subtracted the ERI amounts from my total gain, I have probably overpaid CGT rather than underpaid as a basic rate taxpayer. However, if I was a higher rate taxpayer, I would probably have been underpaying tax if I haven't accounted for ERI. This is because the high rate dividend tax is much higher than the CGT rate. I now understand that to avoid having to calculate ERI on accumulating ETFs each year and keep a running total for each one, most people simply buy distributing ETFs inside a GIA rather than accumulating ETFs, and I'm in the process of ensuring all my ETFs are the distributing kind inside my GIAs. Definitely heard that before. It does make sense. So we've got 4 questions, which we'll answer very quickly in a row. Question 1, should I be concerned about ERI on my accumulating ETFs? Well, it doesn't sound like it matters going forward.
No, I mean, you are sounding concerned, and you ought to be, because if you're not reporting the excess reportable income, then you need to be doing so. But if you're switching, then the problem disappears, doesn't it?
Yeah.
Because then you'll get the distributions, and you know exactly what the distributions are.
What it'll be, so that's okay. Concern is an interesting word. I'm wondering whether your third question is why you might be concerned.
Yeah, that's where my
about HMRC.
Yeah.
But your second question is, do accountants calculate ERI for their clients on all the accumulating ETFs they hold? If so, how do they do it? As there doesn't seem to be an easy way. I feel like an accountant should be able to do this. I mean, it's kind of bread and butter. If they can't or if they won't, then it's probably time to find a new accountant. But it does depend on the platform. You know, they can't calculate information, can't do a calculation without the information they need to do it. So it would depend on the platform, what kind of information it produces. But, you know, they should be able to. It's just maths at the end of the day. Question 3, do HMRC ever check, this is what you're concerned about, that the ERI on accumulating ETFs has been declared? My guess is that they would only bother for high-rate taxpayers with large ETF holdings. How would HMRC even know that you hold large amounts of accumulating ETFs on which you should be declaring ERI? Well, they don't.
As with all taxation affairs, you do a self-assessment. You are declaring all the income and the capital gains and everything you've got.
Yeah.
It's based upon you telling the truth.
Yeah, I mean, interest from banks, the banks tell the revenue, right?
Yeah.
Because the HMRC will send you a letter with a calculation if you don't have to do
Yeah.
All right? Obviously, pensions paid out to you are under PAYE, so,
anyway, yeah.
you know, the revenue know about that. But investments, they don't, do they?
No, not at all.
And so, it's up to you to tell the truth, but they can spot check you anytime.
And once they spot check you,
they'll
probably dig in a bit.
I should say so.
Yeah, I had this, and I think I mentioned it on the podcast before when I first joined CIS. Because we were technically self-employed at the time. You could claim your mileage and use of your car to get to and from your debit and stuff like that. And
that's the area that you worked in.
The area you worked in. Yeah. So I lived in one area, and I covered a different area for CIS. That's my called my debit, the area I covered. And I was claiming mileage for all the mileage I did whilst I was working.
Oh, yeah.
And the taxman came back to me and said, well, you live there and you cover that area. That's travel to work. You can't claim for that, matey.
So I thought, matey in the letter.
Yeah. so I said, well, I didn't know that. And thankfully, and then I had to declare for the past X number of years that I've been doing it. They didn't do a deep dive on me. I just said, well, okay, sorry, I'll recalculate those. And I just told them what the figures were, and I owed them some money, and I paid it back. It wasn't bad. But I didn't know what I didn't know. So, you know, it's all about self-declaration. So,
and be prepared to justify it, you know, if they do decide to check. Didn't know you were a tax evader, Rog.
No, well, I tried, but it didn't work. So I thought better get, especially doing this job, you know.
Yeah, exactly. Why is it that hardly anyone seems to know about ERI on accumulating ETFs? Because it's really boring, right? No, I mean, it's the right question. I mean, I might do a video on it, sort of thing. That's sort of thing, a little bit of pillar content that it'll be when people are searching for it, it might come up, you know. But it's not mainstream stuff. This is. Most investors are completely naive and unbothered, really. As long as they get the returns, then you know they're not too worried about it. They're usually obsessing about which fund to buy and what the returns are like than about the details of taxation. So it might be something to do some content on. And
it might then lead you to why am I doing ETFs rather than OICs,
where it's not a problem.
It's not a problem.
Yeah. I mean. I think it's a pretty good advert for OICs. But I think shifting them to distribution fixes the issue.
Yeah, it does. Yeah.
Question 4, Rich.
Question 4, this is from Agnes. It says, good morning, both. Good morning,
Agnes.
I would like to start by thanking you for all the hard work over the past decade or so. I am a mid-40s-year-old woman who has no financial knowledge until about 2 years ago. I had a cancer diagnosis, which led me to leave a very time-consuming and stressful job and take over the family finances, which had been neglected for the best part of 20 years. We are now in a much better position. We have filled our ISAs and that of our children, put more money into SIPs and opened one in my case, and opened junior SIPs for our kids. Our mortgage is paid off too. I've listened to all your back catalogue and in some cases re-listened to episodes which have been especially useful to our situation. Thank you. Well, if you can sit down and go through the back catalogue, you're a better man than me, Agnes. My question relates to funds that have been done particularly well and what best to do with them. Some of my earlier fund choices are showing gains of around 50%. This seems extraordinary to me, and I'm very happy with the return. My dad, who's much more experienced, who's been doing this for 50 odd years, tells me the best thing to do with these funds is to take out 50% of the gain and reinvest in a different fund. Come back to that in a minute.
Yeah, we will.
What would be your advice? We don't give advice, I'm afraid, but we'll give you some of our thoughts, Agnes. Yeah. Take out the whole lot and reinvest it. Take out 50% and reinvest that as recommended by my dad, or leave the whole lot in and hope it continues to grow. For background, I'm very happy with the gains, but we are very much on a catch-up program as we have started so late. The sums involved are still quite small. The ultimate aim is for my husband to retire early. I hope to work again too at some point once all treatment is finished, but only part-time. I'm so grateful for everything you have done and always wait eagerly for the next episode to drop. With very best wishes, Agnes.
Well, thank you very much, Agnes. Thank you for listening to all the episodes. That's incredible.
Yeah.
And obviously wishing you well for recovery. Hope that the treatment, I would hope it's finished by now, given that we're answering questions from January, but hope you're doing okay. You know what? We're so influenced, aren't we? And there's so many voices. I mean, Kate was just saying to me this morning, you know, with this, because she's going to be buying a house, that she's already been inundated with well-meaning, you know, thoughts and advice, you know, from colleagues and from friends and all that sort of stuff. And it's like you have to almost let some of it go over your head because it can be very confusing. Everybody's got, you know, it's all well-meant.
Yes,
you know, so motivation is good. So what do you reckon about this advice from Dad then, Rog, that, you know, sitting on a nice gain, take half of the gain out and reinvest that?
Yeah. I'm not wishing to disagree with your dad at all, Agnes, especially if his system has worked well for him in all the years he's been doing it. And well done, Dad. You know, that's not a problem. We're not saying that. But we'd say there's no one best thing to do.
Glad you said that. Yeah, exactly right.
It might be the case if Dad had been buying individual shares as opposed to funds, because, you know, back in time, you know, if your dad's been doing this for 50 years, he's probably buying individual shares back then, because there weren't such thing as funds around.
Yeah, sure.
And then, in order to dilute the concentration you have in an investment in one share, the advice would have been, okay, take some money out and buy something else to spread your risk. Well, when you buy funds, you've got the spread already in place.
Exactly. Yeah. I'm really glad you said that. There is no right way to invest. Okay, we have a view on this, but and you know, we'd like to think we're right, but we know we're not. There is no right way to invest. There's many ways to invest, and you know, as long as it works and you're happy with it, doing what Dad suggests will lead to you owning quite a lot of different funds fairly quickly, right? I mean, let's just say, you know, you set a threshold, right? If a particular investment increases by 20%, you'll take half the gain, all the gain out, or all or half of the holding out, and shift it into something else. It becomes like, you know, when you see those like videos of cells sort of splitting, and then you know, 1 becomes 2, and 2 becomes 4, and 4 becomes 8, and you get this sort of exponential growth in the number of cells. Well, I mean, to a lesser extent, you could very easily end up with a portfolio with 20, 50, 75 funds in, which I'm not sure will serve you very well. So I don't think this is really about diversification, as you rightly say. Agnes is going to get diversification. I mean, I've got clients with millions of pounds in one fund. Yeah. But inside those funds are 25,000 different holdings. So it's like you're getting diversification.
You're already getting that diversification within the fund. Yeah, that's what the fund manager is doing for you. There'll be individual shares that are doing well. He then decides what he's going to sell off and rebuy something else for you. So you don't need to be doing that. As Pete said, he's got clients with, you know, with one fund. Well, within that fund, you've got hundreds of different investments anyway.
Yeah, exactly. If we're seeming a little bit jerky, by the way, if there's some weird edits, that's because there's people drilling outside and we keep having to go and start sentences halfway through again. So I talk, and we have talked here in the past, about core and satellite investing. So, you know, if having just one fund kind of makes you nervous, or one approach makes you nervous, then you could, a core and satellite approach basically says that most of your wealth building is done in a single approach, a main sort of, and we would always talk about, you know, asset class investing, passive investing, global, all that sort of stuff. But if you want to then have some fun around the side, you can do that. right? And you can do that. Those would be your satellite investments. You're not betting the farm on them. You're not sort of betting your future on them, but you're just having some fun around the side and diversifying a little bit. But you don't need to do that. I don't do that. I have a single fund.
Yeah, me too.
And it's just, I let it get on with it. I would just say, don't get too hung up on the fact that a fund has done well, right? Or even sort of thinking about the numbers of that fund in isolation. So Fund A has grown 50%, thereby that's done really well. I would only start to think about diversification, if you want to think about it at all, if that fund becomes an uncomfortable proportion of the whole, right? So that's the only thing really to think about as opposed to individual funds. Has it basically become unbalanced?
Because you've probably taken, Agnes, some time to decide on your fund anyway. So in your process of what sort of funds do I want, and I've gone for this one, why then would you spend a lot of time then moving out of that if the fund is doing the job for you?
Yep.
Yeah.
Okay, this is question 5. This is from Lisa. Hi, hope you are well and can help a Cornish lass.
Well, we'll try.
Does get you a buy into the second round, I think. So yeah, fair enough. I am 35 and have never been able to budget or manage finances. In fact, I've always buried my head in the sand. You and loads of other people, Lisa, don't beat yourself up. Unfortunately, when lockdown and maternity leave hit at the same time, geez, yeah, that was challenging, we couldn't afford our debt repayments. We'd purchased a house in January of 2022. We had no choice but to take out an IVA, an individual voluntary agreement. We are now in the 6th year of this, as it was extended as we couldn't release equity from our home. This is due to end in November of this year, and I've been doing my best to learn about budgeting and managing finances ready for when this ends. I've started a spreadsheet to start tracking expenses, and I aim to start an emergency fund plus a pot for putting some money away for Christmas and birthdays. I've been discussing this with my husband, and he thinks we should get an overdraft as soon as the IVA finishes to start building our credit rating, whereas I think we should get a small credit card that we pay off each time we use it. What do you think we should do as our first few steps coming out of the IVA to build more security for our future? Thank you in advance. Kindest regards, Lisa. Well done, Lisa.
Well, yeah, well done. You're doing what you're doing.
6 years of an IVA, getting it clear. That's really, really great work.
And then putting the work in behind, then say, okay, let's look at what our budget's doing. We need to make sure from now on, you've learned from what's happened, and it's been an unfortunate set of circumstances.
Yeah, it's so often the case.
It's not your doing, ultimately.
Yeah, exactly.
But saying, okay, let's make sure we secure ourselves for our future and doing all the right things.
They say that so many people are one set of circumstances like this away from major debt problems, homelessness and everything. So the fact that you've been able to stay in your home and, as Rod said, you're thinking about emergency funds, sinking funds for Christmas and birthday, stuff like that. You're thinking about and going to be doing all the right things. So be encouraged, right? Now, when it comes to building credit rating, we talked a little bit about this on the Bank of Dad podcast, which check out, you might enjoy. So I would far rather, personally, I would go with Lisa on this one. I just, overdrafts, I don't, they feel more negative to me. And it feels like you're starting from less than zero every time. And it's just that bit easier to dip more into it. It just feels like that. There's probably no objective truth.
Yeah, and in my experience in the past, when I worked for the bank and I was a lending officer for the bank, people found it difficult to control overdrafts compared to what they could do on a credit card. Now, they both got their drawbacks. A credit card is in your pocket. You don't see the money. It's going and going and going. But the same could be with the overdraft. People would write checks on their accounts with not having any money and just expect us to pay it.
Yeah.
And then when the pay packet comes in next month, that slightly gets taken off it already.
Yeah.
And you don't really see your full pay packet. What you've got, the benefit with the credit card is your full pay packet comes in and say, right, okay, what do I need to pay off my credit card now?
Yeah, I feel like a credit card could be more visible these days than perhaps it was then, only because, if you like, I don't know, let's say you have a Monzo credit card or whatever, the balance is right there every time you log in. And, I mean, you're going to need, and it sounds like you're heading for this, you're going to need to be absolutely laser focused every single day. There's going to be no let up, right? But in order for you not to get in the same position where you were, you're going to have to track your spending every single day, keep an eye on it, and make sure that an overdraft or a credit card doesn't just slightly fall out your grip. So important. Tiny little things can compound, and you end up in a worse situation again. We talk about building a starter emergency fund, doing that as quick as possible. So look for stuff you can sell. Put as much as you can away into that as possible before you start thinking too much about Christmas and birthdays and stuff. Try and get 500 to 1,000 quid a month, 500 to 1,000 pounds behind you as an emergency fund. It's a buffer between you and, the washing machine breaking down, or you needing to put new brake pads on the car, or whatever. I think Martin Lewis is a gift to this nation. He's probably done more than anybody else to improve the financial health of the nation. I feel like financial advisors love to hate Martin Lewis because he doesn't talk a lot about investing or pensions, but he's really changing on that recently.
Yes, yeah.
Yeah, but the point is he's brilliant at stuff like this. So we've got a link to a Money Saving Expert article on credit cards for people with bad credit. So read that. Just a little bit. The Nick has clipped this from the website for us. So use them for small everyday spending. So just little bits. Maybe just say we are only going to put our food on the credit card, right? And obviously then repay it in full each month, because that's good use of credit and will build your score. Anything else to watch?
Yeah, they do. He does actually say within there, actually, what the Pete's just said is set a direct debit up to pay the credit card, so it's going to come out. So you haven't got to, because sometimes the bill comes, you think, oh, I better check what's on there, and it gets put aside under another pile of paper, and you forget it. And what you don't want to do is miss the payment, even at the minimum payment at that point in time.
No, exactly.
But the thing really to watch, as Pete's hinted at, is higher interest rates.
Yeah.
If you've had credit problems in the past, then if you're applying for a credit card, you'll probably find the interest rates should be high. Another reason not to leave any outstanding balance.
Absolutely right.
It's they'd be crippling. We're talking between 30 and 35%, which is still ludicrous when interest rates are the way they are, really.
Never ever withdraw cash on a credit card. Stupid charges and very often additional interest rates on that, right? That is, just don't ever do it. And if for whatever reason you get a balance on there that you can't fully repay at the end of the month, don't miss that monthly payment, right? Because that's your credit rating will go fairly sharply into reverse, right? So tread carefully, stay focused, but you've got this, Lisa. I think you need to both be together on this. This can't be one of you driving it. You need to be both committed to this, and the future is bright. So good luck to you from us.
And I think the saving grace for you is that you weren't spendthrifts and getting rid of your money to begin with. It's a set of circumstances that came along, so your mindset is already in the right place for you.
But if you avoid that debt in future, you can never get in that same position again. So many of us carry debt, particularly in our younger lives, right? So there's no judgment here. But if you don't get into debt again, you can't get into the situation that you found yourself again. No. So now with the IVA being clear, you're starting from zero. So now start to build. And the future's bright. All power to you. Yeah. Last one, Rog.
Last one. This is from Nick. Says, salutations, Roger and Pete.
Salutations.
Salutations back, Nick. Yeah. My question is what to do with a lump sum inheritancy thing as a younger guy.
An inheritancy thing?
Yeah.
Yes.
It made me laugh, though. Yeah. My parents have been very financially successful in business and incredibly generous to my brother and I, and gifted us each an apartment a few years ago to make use of the first property exemptions. Not sure what that is. And the 7-year gift rule.
Stamp duty?
Possibly.
Okay.
And now that I'm mature enough to understand the opportunity, I've taken control of the management of mine. Yeah. While I understand it's an incredible income-generating asset, I'm not a fan of real estate. Okay. And I'm much more comfortable selling the property and investing in index funds within the variety of wrappers available in the UK. After fees and taxes, should I go through with a sale, I will net approximately £350,000. My plan is as follows. £47,000 into premium bonds because I currently already have 3,000. 40,000 into my SIP, limited by current salary. £40,000 held in cash to be invested into a SIP in year 2, potentially up to £52,000 as my salary rises. The remainder into a GIA, all invested in Vanguard index tracking funds.
Okay.
I'm 26, working as an officer in the military, so I have an incredibly low cost of living. I've got subsidised accommodation and no utilities. Oh, I should have joined the army. And a non-contributory DB pension plan, so no need to allocate money there. And I'm able to max out my stocks and shares ISA yearly just with my salary. I know these steps are good, but having the best part of £220,000 in a GIA paying CGT on the other end of that makes me a little unhappy, especially if I hold it for multiple decades. I'm aware this is a real champagne problem, but do either of you have any recommendations on improvements to my plan and mindset, or are you able to poke any holes in my approach? Should I hold more in cash to later invest into my SIP, bet an ISA SIP over time, spend some of it even? I know it's an aggressive approach, but I'm sort of an all or nothing sort of guy, even with investing, as is referenced by my 70% plus savings rate. But balance has always been hard for me to find.
Okay.
My goal is to be financially independent by 36.
Nice.
Good on you.
Good.
Yeah. I'll likely keep working, but I like the security of that and the saltily coined term FU money. If you know what that means. Whatever you both think, I will deeply ponder over and analyze for many hours. Thank you both for the many episodes of top-tier information. I would apologize for the lack of brevity, but I know you love it really. Thanks, guys. You're both rock stars. Nick.
Thank you, Nick.
Lovely words. Yeah. Really nice.
Okay. So we had a question on the pension, on the amount going in.
Yes, because you said you're going to be investing £40,000 into your pension, Nick. The thing that jumps out at me initially is you've got a non-contributory DB pension plan. There is still some pension input, and it's all based upon the increase in your benefits this year compared to last year. So although you might think you can throw £40,000 at your pension, you probably can't. You will need to find out what your pension input is for the tax year. And unfortunately, you only find out about it the year after.
Yeah, it's annoying.
Because you'll have your annual allowance less whatever the effective input has been.
Yeah. So
it's really difficult. Although that's all employer contribution. So
yeah. But still pension input.
Yeah, it is. Yeah.
So okay, I mean the rest of it, max premium bonds. You know, it's tax free. It's government backed. It's a great place to keep an emergency fund.
Yeah,
that sort of thing. They don't really need an emergency fund, but because of the assets you've got, yeah. So 40 grand into the SIP? Question mark on that. Money held in cash to invest in the second tax year, question mark on that as well for the same reason. The other sort of main point is that you would end up with, more than a couple of 100,000 in a general investment account, and obviously that's not tax wrapped. But you'd ISA it every year. You could bed and SIP every year as well. If you've got any headroom to be able to do that. So yes, you're not going to hold it all in a GIA for multiple decades. You're going to over time tax wrap it. It'll take you a while. Yeah. There's only one of you, 20 grand a year. But, if you can put into pensions, then yes. If you want to be financially free by 36, though, any money in your pension's not going to be accessible for 21 years, at least. So you need to be thinking about other, you certainly need to be maxing ISAs.
Yeah.
Lifetime ISAs 16. So, it might be that the taxation of the GIA is the price you pay for accessibility earlier on. It's not FU money if it's in a pension. No, exactly. And what we've said in several podcasts in the past is that people are wary about paying capital gains tax. So they've got a GIA over here, and if I cash in £20,000, I'll have made a big gain, and I've got to pay tax on it. Yeah. So should I just take out my £10,000 and put that in the ISA because I'll then not pay the CGT? But what you're missing out then is from then on the tax, the growth will be tax free. So, it's worth, in our view, taking your full £20,000 and ISAing it, because then you got long term growth then tax free. Yeah. Even if you pay a bit of CGT on an annual basis. Yeah, just on that one. You take each transaction on its own. Yes, you might pay a little bit of CGT realizing the 20 grand from your GIA, but for every year, indefinitely thereafter, that 20 grand is tax free for life. Yeah. So, that's got to be worth paying a little bit of CGT for. It won't be a lot, given your annual exempt allowance and things like that. I think also, given your goal to be financially independent, although you don't say retire, I don't think you're planning to stop work, but you're going to need flexibility. So you don't want to sock away too much into pensions. So, yeah, I think, even if you pay a bit of tax by having money in a GIA, it's going to be worth it for flexibility.
Yeah, and especially, but you're doing a great job now. I mean, you're saving 70% plus of your income because of
champagne problems. Indeed,
it's not a problem. But as Pete said, you need flexibility for the future, and your goals will change over time. So, not too much into your pension, but I think you may have a bit of a difficulty in putting loads into your pension because of this pension input period.
Yeah, you might want to buy a house. You might find a partner. You might have kids, whatever. You don't say much about your sort of personal situation, but. You might not. Life changes, and we're big believers in flexibility because nothing ever stays the same. Well-laid plans and all that, they end up getting changed just by the universe. So, but it sounds like you're doing a lot right. I just wouldn't worry over much about CGT on a GIA. It's the price of having the opportunities that you've got. I think we all need to pay some tax. It could be worse, right? So you be okay. Don't let it worry you too much.
Well, the other alternative is you just keep it all in cash, get no growth whatsoever, but don't pay any tax. So it's really worth paying the price to do it. Really is.
Yeah, would not recommend you take a £2.25 million worth of cash and stick it under your mattress. Don't do that. No.
The taxman will never know. You never get any growth on it.
Well, you are a tax evader. We've already established that this episode. All right, that's it, isn't it?
Yeah, I think that's it.
Cool.
Hope the answers were helpful.
Always.
If they weren't, it's nothing to do with us.
No.
Just the questions were too difficult. But please do keep them coming in at hello@meaningfulmoney.tv with the subject line podcast question, and we will include it at some point. 6 months later, perhaps. I don't know.
Well, that's it for this week. Thank you so much for listening. Any links that we talked about, go to the show notes, meaningfulmoney.tv/QA52. Hope you enjoyed it. As always, thank you so much for listening. Thank you, Mr. Roger Weeks.
Cheers, Pete.
We'll talk to you next time.